Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Swan, and in each episode I share my thoughts with you on a topic or a recent development in South African tax. And I try to do it in short enough episodes that you can listen to it whenever you've got a gap in your calendar. Now, I think today we can't speak about anything other than the budget that was postponed in February but then finally presented yesterday. Now, the analysis of the expenditure side of the budget and the collections and those kind of things, that I'll leave to the economists. So in this episode, I'm going to highlight some of the important tax proposals that we find in the budget. So if we first look at what you are likely to find in the headlines is, I think, a few proposals relating to the tax rates. The first one is that the VAT rate will increase. It will increase with 0.5% from 1 May 2025 and another 0.5% from 1 April 2026. So in other words, by April next year, we'll have a 16% VAT rate. If you are a regular listener to the podcast, you can go and listen to one of the earlier episodes a week or two ago, where I spoke about the provisions of the VAT Act and transitioning from to a higher VAT rate. I guess that episode would be a bit more useful if you listen to it now. Now, with this increase in VAT rate, there's also an expansion of the zero rating for basic foodstuffs to make that list a bit bigger. And the idea there is just to balance to counter the effect of the higher tax rate for the lower income groups with some relief in the cost of food. The second tax rate related proposal is that the tax rates for individuals will remain unchanged. So in other words, there's no inflation adjustments for the tax brackets. Now, it's called bracket creep, and this is a mechanism that's been used by the Treasury on a few occasions now. So what that would practically mean is that if you are an individual where your remuneration is adjusted for inflation, that inflation adjustment might just put you into a new tax bracket. So some of your inflation adjustments to your remuneration would be absorbed by the fact that the tax rate scales remain unchanged. The rest of the episode, I would like to focus on policy proposals, and so the idea is not to have a full, complete list of all the changes or the proposals. I'm only going to speak about a few of them that I believe would be or could have quite a wide impact based on the aspects that I normally encounter in consultation with clients. Also important here, these things are proposals. They're not yet changes in the legislation. So they need to now go through the legislative cycle and the legislative process before they are enacted and become part of the law. The first one I would like to highlight, there was a survey by the National Treasury earlier this year about the solar incentives or the energy incentives, the renewable energy, and that created the perception that Section 12BA that came to an end on the 28th of February might be extended. It's now been confirmed it won't be extended. So that leaves us with Section 12B, the various thresholds, the position on leasing activities, those kind of things, as the tax allowance applying to these renewable energy projects. Then a topic that I've also dealt with in a previous episode, the diesel rebates. Currently, if you are a primary producer and you've got eligible fuel use, you qualify for a rebate on 80% of that eligible fuel use. That 80% will be adjusted to all eligible use from 1 April 2026. Third point, if you're looking at individuals, there's a ring fencing provision for certain losses that in Section 20 capital A that only applies to persons who are taxed at the maximum marginal rate. So it's often activities like leasing, like farming activities that could be subject to this ring fencing provision. The Treasury announced that they will review the thresholds, and I suspect what that means is that this provision may be extended to also apply to taxpayers who are not necessarily taxed at the maximum marginal rate. The fourth one, and I think this moves into the corporate tax space, is that the Treasury indicated that they will review the definition of a hybrid equity instrument in Section 8E. Now, this is something that you typically find when you're dealing with, for example, preference shares. And what this provision essentially does is to say if you've got the legal form of a share, but the terms of this instrument means or implies that it's got a lot of characteristics of debt, then although what you're paying out is a dividend, that dividend will no longer qualify for exemption. So in other words, the dividends in respect of these instruments become taxable, like interest would be taxed, for example. I suspect, depending on the scope of the changes, this could actually be quite a big amendment if it happens. Still on the corporate tax space, Section 23M limits the interest deduction where interest is paid to certain related counterparties who are not taxed on the interest. So it often applies in a cross-border context where a South African entity pays tax or pays interest to a related foreign person. And Section 23M then limits the deduction of your interest if that foreign person is not taxed on the interest. Now, a few years ago, Forex was included into the definition of interest, so your foreign exchange losses. And there is some concern that if you're looking at foreign exchange losses, where the corresponding gain isn't something that should be taxed in South Africa, how you then apply Section 23M. So the announcement is that that will be revisited. Sixth point, the conduit principle on trust distributions to non-residents. Now, you may know, and there was an episode before, I've also recorded another one that's in the pipeline. Now, that conduit principle will no longer applies to income distributed to non-residents from the 1st of March 2024. The Treasury indicated that this amendment has got some unintended consequences for the non-resident beneficiary. So one of the obvious problems is that they can't necessarily get a credit for taxes that they didn't pay themselves. So based on these unintended consequences, this rule will be reviewed again. From an administrative perspective, there's a proposal to investigate and consider the possibility of designating single entities within a group to administer the employees' tax on behalf of the group. So that could be a welcome administrative convenience if that's allowed. And then lastly, a proposal relating to penalties, and it specifically relates to bona fide inadvertent errors. Now, there's been quite a bit of case law and development in this regard, and what the substantial understatement penalty rules currently say is that if you've got a substantial understatement or you've got an understatement as a result of a bona fide inadvertent error, then there can't be an understatement penalty on that. Now, what the proposal is to say that this bona fide inadvertent error exception must only apply to substantial understatements. So in other words, those are understatements where you've already shown that there was reasonable grounds for the position taken, there was care taken, and you're ending up with the last behavior on the penalty table. That is the substantial understatement category, and the proposal is that the bona fide inadvertent error exception must only apply when you find yourself in that category. That's it for today's episode. Thanks for listening, and if you've got any comments, questions, ideas for new episodes, please send me an email. My email address is in the show notes. If you like the podcast, please subscribe, like it on YouTube, and tell all your friends and colleagues about it. And then, as always, the podcast is not intended to be tax advice, and maybe an additional disclaimer or qualification on today's episode. Just bear in mind that these things that I've spoken about and that you find in the budget review are only proposals. So if you might be affected by it, look at the budget review document, follow it as it develops, but don't just rely on the podcast. The podcast is only intended for information purposes. Until next time, goodbye.